I just mentioned consumer sentiment numbers out after the open today. And well, I got to tell you, it's below consensus, right? And really, it's not affecting the stock market, but I got to tell you, this is really, truly amazing, right? So, of course, it's unlikely the Fed is ignoring this data, by the way, because remember, Powell, this once moved Powell. You guys may remember it was a couple of years ago. He made a huge U-turn because of that one inflation number associated with this. It roiled the markets for a long time. Of course, that was then. This is now the most recent Jackson Hole has now set up a new direction for the Fed. But the news combined with yesterday's headlines, think about this, record high household wealth underscores this sort of paradoxical world in which policymakers and investors are trying to maneuver, trying to navigate. I'm going to bring in now Prinsights, a global founder, Nomi Prins, and Manhattan Institute senior fellow Allison Schrager. And Nomi, Allison, let me start with you because you wrote this piece just a couple of weeks ago. How can an economy this good feel this bad? And I hope you have the answer.
Well, I mean...
by the way, it sounds like a great 70s love song, but yeah.
Well, in one word, it's inflation. I mean, people definitely feel like their real wages still have not matched 2020. I think we're also now seeing that the labor market really hasn't been creating jobs. It was initially, after the pandemic, and it slowed a lot. If you have a child finishing college, they're probably having a really hard time finding a job. If you're in a job, you probably don't feel like you could move to another. And as I said, price levels still are higher. Inflation still is at 3%. So I think people are feeling a lot of uncertainty.
Right.
So anyway, their wealth might be higher than ever, and their real wages might be increasing. We also saw that. I think they're also feeling like this is not something they can trust.
And Nomi, in America, there's also, I think, this sense of not keeping up. It's always interesting when economists say, well, the poorest person in Mississippi lives better than the richest person in some Western European nation. But we don't compare ourselves to anyone else except each other. And there's a feeling like the distance is widening.
Well, that's right, because yes, there's inflation. Yes, even though it's slowed down since post-pandemic, it's still there. Prices are still going up, and household debt is at record highs as well. So we see on the one hand, household wealth is at records, and then household debt is at records. And that push-pull between who's actually accumulating the wealth and who's actually subterfuge beneath, not being just a part of that, is where that confidence number is coming in. And I think all eyes are on the Fed for whether they've been behind the ball on this particular move.
I think in the 90s we had this so-called jobless recovery. Can we have a jobless country? In other words, we had 2.5 million fewer jobs in the last three revisions, but things are working. Is this going to be a fact of life in your mind?
We are not going to be creating as many jobs. There's going to be a conversion of jobs, whether it's technology, AI, into new kinds of jobs, into production, into the U.S. supply chain becoming a homebound supply chain, which it hasn't been, which this administration is trying to do and incentivize. And there's going to be shifts in how those jobs look. But for the meanwhile, those jobless numbers where we've seen 4.3% versus 4.1% when the Fed cut 50 basis points last year, now are 4.3. That's going to continue to impact job.
So here's the thing, Allison. We had yesterday. I told the wealth number. Just want to let the audience know. So a record 176.3 trillion, up 7 trillion. In fact, we're at 118 trillion since 2000. But if you look at it, the top 10% has 81 trillion of that. The mid 40% has 35 trillion of it. So the Fed, one of my big beefs with the Fed is they look at this aggregate data, but to me, it's getting more and more skewed, and more folks are being ignored. And I feel it's interesting because people who argue about Fed policy, like this is a bad time to hike lower rates, are looking at it from Wall Street's lens. But I think if you look at it from a Main Street lens, it looks a little different.
Yeah, I mean, the Fed's in a tough spot because really, if you're in a Main Street lens, you really care about price stability because inflation does hit you hard. And lower rates will also increase the stock market further, which will be good for richer Americans.
But this should be, it doesn't matter to the person who's not in the market, whether it's up or down, right? I mean, but their credit card bill went from 16% to 22%.
Mm-hmm. Yeah, although, probably the Fed will maybe cut 25, maybe 50 basis points. That probably isn't going to make a huge difference for consumer credit. And where a lot of Americans are struggling is the housing market. And that's because the Fed did so much to lower mortgage rates during the pandemic and then had to raise rates once inflation appeared. And they're not going to hopefully bring back QE again where they're buying all the mortgage-backed bonds. So we sort of have this weird housing market where half of people have mortgage rates below 4%, and then all these other people are feeling shut out. And there's no good way for the Fed to manage that. I mean, this was largely their error to begin with, but there's no good way out of it.
Right. Although mortgage rates are coming down now, there's more supply, 500,000 more sellers than buyers. Maybe that will help a lot as well. You wrote about the Powell president, right? And essentially with the Jackson Hole meeting, August 22nd of this year, where they sort of said, okay, I don't know if they're permanently abandoning the 2% goal, but certainly they're not looking at it. They put labor over inflation. The question, though, is it too little, too late?
Yeah, he missed. Yes, last year he said labor was cooling, and that was the impetus for 100 basis points between 50 in September and the rest of the 100 over the rest of the year. I think we're going to see 50 in September soon for the same reason, but this year he talked about slowdowns in labor as opposing to cooling down. So he started to open that door to actually pay attention to what's happening in the labor market with respect to what's going to happen with rates. And I think that's going to impact mortgages. It's going to impact the 10-year more than it did last time, because there's other things that are coming from the Treasury Department in terms of Treasury buybacks on the Treasury side. There are regulations that are going to help banks.
Though. It's the buybacks and also the focus on bills rather than bonds.
Well, the rates are going to impact bills. And what happened last time is it didn't really impact bonds, because we have a lot of buyers basically who stepped out of the U.S. Treasury market from a foreign buyer standpoint. But we do have other buyers coming in. J.P. Morgan and Chase this quarter bought 22% more 10-year and 7-year Treasury bonds than the quarter before. So there's definitely a kind of precursor to what could happen in the long end happening.
I got a minute to go, and I know you want to, but also throw this in as well from the Manhattan Institute. There was a piece there. Here's what would happen if we seized all the wealth from America's 800 billionaires. We have a guy who's running as a socialist, probably be the next mayor of New York. And I don't think it's a unique situation. You see in these latest polls, capitalism is free falling in favorability. What do you tell people who think that we have to take such tragic measures?
I think we have to, and it's a hard message to convince people of right now, that the economy is not zero sum. And if you punish billionaires, you're not going to be any better off. In fact, a high tide does raise all boats. I know it's hard to believe sometimes, but in a lot of ways our life is better from a lot of these billionaires. And so seizing their wealth is not going to make you richer. In fact, it will make everyone poorer.
And what do you see from the Fed next week? 25 or 50 basis points?
Well, I hope they do 25, but they may do 50 because I think they're buckling to political pressure.
Nomi?
I think they do 50 because of what's happening in the job market relative to last year when they did 50.
Right. I mean, what bothers me is they were data dependent, and then they weren't data dependent for a moment, and now it looks like they're data dependent. You got to wonder if they're a little bit too late. I'll tell you right now, I think Wall Street secretly wants a 50, but we'll see. Wall Street always wants the more accommodation, the better. Ladies, thank you both very much. I wish we had more time. Great stuff. I really appreciate it.